Welcome to the deep dive. Today we're jumping into a company that's definitely been in the spotlight, AMC Entertainment Holdings.
That's right. And we're aiming to get past the headlines, really dig into the details that matter for understanding, where things stand.
And we've got some interesting sources for this. First up, there's an analysis using Hamilton Helmer's 7 power laws framework.
Right. That helps us look at the business structure itself. Does it have, built-in advantages that are tough for competitors to beat?
Exactly. And we're pairing that with key financial figures pulled directly from an excerpt of AMC's own 10K filing. Real numbers.
So our goal here is basically to blend these two views, the hard financials and that structural power analysis, to give you a clearer, faster way to grasp AMC's current situation.
Yeah, because wading through SEC filings and strategy frameworks can be, let's be honest, a bit much. We want to break it down and make it make sense for you. Okay, let's dive right in. Financials first, based on that 10K bit.
Okay, so comparing the full years ending December 31st, 2024 and 2023. The big picture on revenue is a slight dip. Total revenues were down.
How slight?
About $175 million, give or take, which works out to a 3.6% decrease, landed at $4.6 billion for 2024.
Okay. And what about the main parts of that revenue? Tickets and popcorn, basically.
Yeah, admissions revenue and food and beverage revenue. Both were down year over year. Admissions fell almost 5%, and food and beverage was off by nearly 3%.
And that lines up with fewer people actually going.
Exactly. Total attendance dropped pretty significantly. We're talking 15.3 million fewer patrons.
Wow.
Yeah, that's a 6.4% decrease. And the source does mention that this was partly tied to those Hollywood labor stoppages the year before. Fewer big movies hitting screens in 24.
Right, the film slate impact.
Well,
but hang on, wasn't there something interesting happening with how much each person spent?
Oh, yeah, good point. Even though fewer people came, they actually managed to get more money out of each moviegoer. The average ticket price nudged up 1.6% to $11.42. And maybe more impressively, food and beverage spending per person jumped a solid 4.0%, up to $7.25.
So they're getting better at selling concessions and maybe charging a bit more for tickets?
It seems like it. Shows some strength in pricing or upselling, maybe, but clearly it wasn't enough to make up for the sheer drop in the number of people walking through the doors.
Right, the volume decrease was too big. Okay, let's shift to profitability. How did the operating loss look?
It actually got a little bit worse, went up slightly from about $74 million loss in 23 to a $79 million loss in 24.
Okay, so still losing money on core operations, but I thought the net loss improved.
It did, technically. The net loss decreased by over 11%. But, and this is but according to the source, this wasn't really about the core business suddenly doing better.
Ah, okay. What was it then?
It was heavily influenced by a bunch of other income items in 2024. Things like gains from paying off debt early, money from lawsuits, changes in derivative values, stuff like that. Partially offset by some fees from refinancing debt, mind you.
So accounting gains rather than operational ones, mostly. What about adjusted EBITDA? That often gives a clearer operational picture.
Yeah, and that paints a, less rosy picture. Adjusted EBITDA saw a pretty significant drop, down $110 million.
Percentage-wise?
That's more than a 24% decline compared to 2023.
Oof. Okay, so that really underlines the pressure on the actual operating performance.
Definitely. Now let's look at the balance sheet, cash situation.
How much cash did they have on hand at the end of 24?
They finished the year with $632 million in cash and cash equivalents. But that was down quite a bit, a decrease of $252 million during the year.
So burning through cash, what about working capital? The short-term health measure.
That's another area of concern highlighted. The working capital deficit, basically, short-term liabilities exceeding short-term assets, excluding restricted cash, got much wider.
How much wider?
It increased by nearly $390 million just in 2024, ended the year at a deficit of $846 million. That suggests, growing pressure on their immediate ability to cover obligations.
That sounds worrying. What about debt? I know that's a big topic for AMC.
Right. On the positive side, the total principal amount of their corporate borrowings did come down. They reduced it by about $370 million, which is an 8% decrease. Shows they are actively trying to manage that debt load, like the source mentions.
So they paid off some debt?
Or exchanged it, refinanced it. But yeah, the total principal was lower. However...
There's always a however, isn't there?
Well, yeah. Despite owing less principal, the amount they paid in interest expense actually went up, increased by almost 8% in 2024.
How does that happen? Less debt, more interest.
The source points to the terms of the new debt they took on through refinancing. Basically, they might have pushed out the deadlines for paying back the debt, but likely had to agree to higher interest rates to do so.
Okay, so kicking the can down the road, but it costs more in interest payments now.
Potentially, yeah. But there was a notable positive on the cash flow side. Net cash used in operating activities improved significantly.
Meaning they burn less cash just running the business day to day?
Exactly. They still burn cash from operations overall, but much less. It went from over $215 million used in 2023 down to just about $51 million used in 2024. That's a $164 million improvement.
That's definitely a step in the right direction. Still negative, but better.
Much better. Meanwhile, capital expenditures, money spent fixing up theaters, buying equipment that picked up slightly, about 9%.
Okay, so pulling all these financial threads together, what are the major risks that stand out from this 10K data?
Well, the risks are pretty clear, I think. You've got those ongoing financial pressures, revenue and attendance falling, the operating loss persisting, and that big hit to adjusted EBITDA.
And the cash situation.
Absolutely. The liquidity concerns are real. Cash reserves going down, that working capital deficit ballooning, that's definitely a risk factor.
That's a mountain of debt.
Yep, the debt burden. Even with the principal reduction, it's still huge. And the cost of servicing that debt, the interest expense, actually went up. That's a major constraint.
And the core business itself seems vulnerable.
Right, the operational headwinds. Highly dependent on factors outside their control, like the movie studios delivering appealing films, as shown by that mention of the strike impact.
And the source explicitly says they need revenues to get much closer to pre-pandemic levels to have sustainable positive operating cash flow, right?
It does. They basically admit they're not there yet, and getting there is crucial. That's a big risk. What if attendance doesn't fully recover?
And we know they kept raising money by selling stock early in 2025 too, which the source mentions, suggests they still need cash.
Yeah, that points to an ongoing need to bolster the balance sheet. And one other thing, those non-cash impairment charges they took in 2024, over $70 million.
What does that signify?
It means they're officially saying some of their assets, likely theater locations or equipment, aren't worth as much as they previously thought. It's a write-down reflecting the tough environment's impact on asset values.
Okay, so significant risks across the board, operations, liquidity, debt, external factors. Are there any potential positives or growth drivers mentioned? Any strategic path forward?
Well, like we touched on, those increases in average ticket price and food and beverage per person are bright spots operationally.
Right, squeezing more juice from each lemon, so to speak.
Exactly. It shows they can execute on getting more revenue from the customers they do have. That's something.
What about strategy beyond just pricing?
The 10K excerpt really highlights their focus on managing the financial structure. All that activity around debt, repurchasing it, exchanging it, refinancing to push out the due dates.
And selling stock.
And using equity issuances to raise cash, yes. These aren't really growing the business itself, but they're critical maneuvers to manage the finances.
Trying to stay afloat and give themselves breathing room?
Pretty much. It's about managing the balance sheet, reducing debt principal where they can, and fundamentally buying time.
Buying time? For what?
Well, as the source implies, buying time for the core movie-going business to hopefully recover. Their path to sustainable positive cash flow seems entirely dependent on getting attendance and revenues back up near those pre-COVID levels.
So the strategy is manage the finances very actively and hope the market comes back strong.
That seems to be the core of it, based on this summary. Aggressive financial management plus waiting for a theatrical resurgence.
Okay, this financial picture is, well, complex, challenging, but with some active management happening. Now let's switch gears completely and look at this through that other lens you mentioned, Hamilton and Helmer's 7 power laws. How does that framework assess AMC's fundamental business strength?
Right, this is less about the numbers right now and more about the underlying structure. Does the business have deep defensible advantages, what Helmer calls power, that should allow it to consistently earn better returns than competitors over the long haul?
Okay, so let's walk through them. The analysis we have gives ratings. Law 1, scale economies. How did AMC rate there?
Scale economies got a 5 out of 10, so right in the middle.
Meaning,
yeah, being the biggest chain probably gives some advantages, maybe better deals on buying concessions in bulk, perhaps a little more leverage with studios, spreading corporate costs over more screens. But the analysis notes that many core costs, running the actual theaters, staffing them, tend to scale pretty directly with size. So being bigger isn't necessarily a massive cost advantage over, say, the next biggest chain. It helps, but it's not overwhelming power.
Okay, moderate benefit from size. Got it. Next, Law 2. Network economies.
This one scored very low, a 1 out of 10.
Why so low? Don't more locations help?
Not in the way Helmer defines network effects. A true network effect means the service gets better for me as more other people use it. Think Facebook or maybe Visa.
Right.
But my experience watching a movie at my local AMC doesn't really improve if someone in another state also goes to their AMC. A full theater locally feels better, sure, but that's not a scalable national network effect driving value or customer acquisition based on the network size itself. Loyalty programs help keep existing customers, but they don't create that core network power.
Makes sense. My movie doesn't get better because the AMC network is large. Okay. Law 3, counterpositioning.
Also a 1. Counterpositioning means doing something fundamentally different from incumbents in a way that's hard for them to copy without hurting their existing business.
And AMC isn't doing that.
The analysis says no, not really. Their core model showing movies in theaters is the industry standard. It's directly challenged by streaming, but AMC isn't fundamentally structured differently in a way that protects it or makes it hard to copy. Any innovations like fancy seats or food are generally imitable by competitors.
What about the whole meme stock thing? Isn't that unique?
The analysis addresses that. It frames it as a market trading dynamic, maybe a branding element, but not structural counterpositioning of the business model itself. It doesn't change how they fundamentally operate or compete in showing movies.
I see. So not truly disruptive in its core business. Law 4, switching costs. How easy is it for customers to leave?
Very easy, apparently. Another 1 out of 10. Switching costs for consumers are extremely low.
Yeah, I can just go to the Regal down the street or stay home.
Exactly. Choosing another theater or choosing a totally different form of entertainment, super easy.
Yeah.
Loyalty programs might make you pause for a second, think about your points, but it's not a major barrier. Very low friction to switch.
Okay, low switching costs. Makes sense. Law 5, branding. They're well known, right?
They are. Branding got a 4 out of 10. So better than some others, but not top-tier power.
Why not higher?
Well, the reasoning is, yes, it's a recognized brand, the largest chain, has a loyalty program and huge awareness, especially from the whole ape community thing. But does that brand typically allow them to charge a significant price premium just for the AMC name? Probably not for the average moviegoer.
Yeah.
Things like location, the specific showtime you want, maybe how nice that particular theater is, those often matter more.
And the meme stock awareness.
High awareness, yes. But the analysis argues it doesn't necessarily translate into structural pricing power or make it cheaper to acquire the broad base of regular movie customers outside that specific investor group. Awareness isn't always the same as brand power in Helmer's sense.
Okay, recognized brand, some loyalty, but maybe not commanding power. Law 6, cornered resource. Do they own something unique and essential?
Rated a 1. The analysis sees no evidence of AMC having exclusive privileged access to some critical, scarce resource that competitors can't get.
Like what? Exclusive movie rights?
Exactly. They don't have long-term exclusive deals with major studios for all their films. Their real estate, while extensive, was acquired over time in competitive markets. It's not like they own the only possible locations. No unique proprietary technology is mentioned as a cornered resource.
What about their ability to raise money quickly through stock sales because of the meme phenomenon? Isn't that a unique resource?
The analysis touches on this. It calls it a unique financial resource, but frames it as potentially volatile and not the same as a sustainable structural business power based on operational resources that competitors are locked out of. It's about access to capital markets, not a cornered input for the movie business itself.
That's a key distinction. Okay, last one. Law 7, process power. Are they just way better at running theaters than anyone else?
Also rated a 1. Process power would mean having unique, complex, hard-to-imitate ways of doing things internally that give a durable cost or quality advantage.
And the verdict?
The analysis finds no public evidence that AMC possesses such proprietary, superior processes. Running a movie theater involves many standardized tasks and systems across the industry. While they likely aim for efficiency, there's no indication of a unique, defensible process advantage.
Wow. Okay, so looking across all 7 power laws based on this analysis, the picture is pretty stark, isn't it?
It is. It suggests a business with quite limited structural power. Scale and branding got moderate scores. But most of the laws, network effects, counterpositioning, switching costs, cornered resource, process power scored very low.
Meaning the core business model, according to this framework, doesn't have strong built-in defenses. It's vulnerable.
That's the takeaway from the Seven Powers lens, yes. Vulnerable to competition, vulnerable to shifts like streaming, lacking those deep structural moats.
Okay, this has been really insightful, looking at both the nitty-gritty financials and this high-level structural view. Let's try to wrap this up and synthesize the key takeaways.
Sure. So from the financials, what we see is a company that's, well, very actively managing its situation in a tough environment. They have made progress reducing debt principal. They significantly improved operating cash flow burn year over year, and they're getting more dollars per customer.
Right. Those are the management actions and tactical wins.
But the underlying pressures are still immense. Overall revenue and, crucially, attendance are down. They're still posting operating losses. Adjusted EBITDA fell sharply, cash reserves dwindled, and that working capital deficit grew substantially. And interest costs are up, despite less debt.
And all the financial maneuvering seems aimed at buying time.
Buying time, exactly, with the hope pinned on a major resurgence in moviegoing to get them back towards pre-COVID revenue levels, which the source itself flags as necessary for sustainable, positive operating cash flow.
Then you layer on the 7 power laws analysis.
And that adds a critical layer, suggesting the fundamental business lacks strong inherent defenses. Low scores across most powers indicate it might not have the structural characteristics to easily fend off competition or adapt to big market shifts like streaming in the long run.
Scale and brand give it some presence, but according to this framework, maybe not enough deep-rooted power.
That seems to be the conclusion from the structural analysis we looked at.
So putting it all together, you get this picture: a company fighting hard on the financial front within a challenged industry, but operating a core business that structurally might be quite exposed. It certainly gives you a much richer, more nuanced perspective than just looking at the stock ticker.
Absolutely. It highlights the fundamental challenges beyond just the quarterly numbers.
So thinking about everything we've unpacked from the financials and the power laws, it really leaves you with a crucial question to ponder, drawing from all this material. Given these identified structural weaknesses, the apparent lack of strong defensible business powers, according to the Helmer framework, and the company's own stated reliance on attendance recovering significantly just to break even on cash flow from operations, how can AMC realistically navigate these deep-seated limitations to build something truly stable and durable for the long term?
Yeah, that really is the core challenge that emerges when you combine the financial reality with that structural assessment. It's the big question mark hanging over the future.